All right, let's begin the show today. We're discussing on bonds, and here we are talking about high-yielding bonds. If you're an investor who slightly has a higher risk appetite, looking for double-digit return, that too in fixed income, and we're talking about high-yielding bonds, what are the investment options for you, and what are the criteria based on which you should be considering these kind of bonds? Let's understand all of this with Arnav Pandya, founder Moneyeduschool. Arnav, good evening and welcome to the show. So just to break it down, what are exactly high-yielding bonds where even now there are double-digit returns that an investor can earn?
Evening, Kavita. So there are various types of bonds which are issued by different entities, and these are traded in the secondary markets also. So you have a simple kind of bond which can be an infrastructure bond. You can have tax-free bonds where the interest on them is tax-free, and there are also several bonds where the yields are higher. Now, the high yields can be due to many factors. One of them could be that overall, as the cost of funds in the economy go up, you will find that several of these bonds have a slightly higher yield. And because that there is a risk involved in these bonds, which is there is a credit risk involved, you will find that the rates that these bonds offer are higher than what you see with various other kinds of bonds and debentures which are issued by some other entities which are more are able to raise funds at an easier rate. The second thing is also that, see, many of these entities, for them, it's an inability to raise cheaper funds because they do not have sources to other kinds of funds, which makes them choose bonds as an option to raise funds specifically for slightly longer duration. And due to this, there is a slightly higher yield which is available. So an investor needs to look at the kind of risk that he's able to take, then look at the kind of yields that are available, what kind of companies have been issuing these kind of bonds, and the nature of these bonds before making a decision. Because see, for example, just because two bonds have a similar kind of yield doesn't mean that the risk is similar. Because you have a situation today where several non-banking finance companies have a X amount of yield, and similarly, several state government entities from various states, they also, their various entities which operate in these states for, in say the power sector or other infrastructure sectors, they are also raising money through these bonds, and these bonds also have a similar kind of yield. So one has to be very particular in looking at the nature of the bond, the kind of offering that is, and the kind of returns that one is getting from these instruments.
Right. Let's talk about the risk involved in investing in these kind of bonds, although you've explained a lot of that as well. But then talking about the nature of these bonds, are they secured, are they unsecured bonds? And also, how can one buy these kind of bonds from what platform, from what kind of market?
So see, naturally, when you look at the risk, there are two basic main risks involved in this. The first risk is the credit risk, and that is not applicable to every entity, because as I just explained, you will also have state government and various government entities borrowing from the market. For them, the credit risk is not applicable. But the credit risk is the risk that the entity to whom you are lending money might not be able to repay the amount back when the time for repayment comes. The second thing is that there is also an element of interest rate risk involved if you do not hold the bonds till maturity. Many of these bonds are long-term bonds. So say you buy a 2030 bond right now, and then if you want to get out after 3 years in 2026, then at that point of time, you might face interest rate risk because the interest rates might have moved against you during that period of time, or it could be that that point of time, it's not in your favor. So these are the two main kinds of risk which are there. The point as to where one can buy these bonds, there are primary issues when these bonds are first launched, but at the same time, there is a secondary market available where you can buy these bonds from other investors. One thing you need to be very alert about is that in the secondary market, you might not have the kind of liquidity that you might expect, or it might not, the liquidity might not be there when you want to actually go and buy a specific bond, because in many of these bonds the volumes are slightly less. So there is a secondary market available from where you can buy these bonds. But if you are a small investor who's not buying a large quantity, maybe liquidity might not be that big a problem.
What would be the tenure for which you can be locked in these kind of bonds? Or you should be looking at that kind of an tenure, looking at the interest rate scenario currently?
No, so now the question for you is that what is the kind of bond that you are going to select? Because um, see, if you want to reduce risk, the idea is that you go in for something like a secured bond. A secured bond is secured against some asset of the entity. So that is one point. Unsecured bonds are obviously more risky. So going towards a secured bond reduces one type of risk. The other type of risk is that you match your investment requirement with the maturity of the bond. So you will have bonds which are say maturing in 2024, 25, 26, and even 2030. So if you want to invest for say 2, 3 years, then you select a bond which matures within that range. So then it is easier for you to manage. So it's up to you as to what kind of bond you want to select and the period you want to select. That period becomes important because you have a range of options which are available, and this can stretch up to a very long period of time. So if you don't want to take that kind of risk, then you should actually look at when is your requirement for funds and then select a period which is near to that.
Arnav, also, would you suggest these kind of bonds to senior citizens?
So senior citizens, I mean, they have quite a few other options which are available. Unless you have quite a big portfolio and you have enough amounts by which you have secured your basic requirements and all, I would not suggest these kind of bonds to senior citizens. And even those who can afford to take this kind of risk, I mean, the exposure should be very less. For senior citizens, I mean, within these kind of high yielding bonds, there are various, as I said, state government entities where the risk is slightly reduced on the credit side. So that can be an option for them. But overall, not a very high exposure. Even if you meet the other criteria to have some exposure here, it would be my suggestion to them.
Uh, uh, Arnav, how important would it be for you to adhere to the maturity and not come out of the investment instrument or these kind of bonds before maturity?
So, see, there might be a situation where it suddenly could become very attractive for you to actually come out of the bond even before maturity. Say, for example, you have taken a 4 year or a 5 year bond and it's there in your portfolio. Now, assume after 6 months or after a year, suddenly in when the Reserve Bank of India starts cutting rates, interest rates in the economy start going down, there is a drastic drop. Say there's a 150 basis point drop in the interest rates. If that happens, what will the situation that you will be faced with is that you will have a massive capital gain which is visible on your holding. In that case, you might want to even get out slightly earlier because that capital gain is quite significant. Because what happens is that if you still hold it to maturity, then that yield will come back to the point of your investment. And what returns that you are seeing in the intermediate period just because of the fall in interest rates, that might come down to the level at which you invested in the instrument. So that could be a situation where you might want to get out slightly early. The other reason could also be that you have some requirement of funds, and which is why you want to exit the bond. These kind of situations can come up. So one has to be prepared for that also. And that one must keep in mind because that is very important as it will ultimately affect the kind of final returns that you are getting from these kind of bonds.
Last question, Arnav, and then we'll wrap up this discussion. What kind of bonds or high yield bonds are you recommending, and what would be that one thumb rule that one should be keeping in mind before opting for those recommendations?
So there are various non-banking financial companies which are issuing these kind of bonds, which you will be able to get in the market. One thumb rule, which I would say at the moment, is that focus on ensuring that the companies in which you are investing or the entities in which you are investing do not have a very high risk element involved in them, because a lot of these NBFCs which are say working in the microfinance sector, or which are working in the new personal credit and personal loan and other segments, they might have a very good outlook at the current moment, but one has to look at the kind of pedigree that it has, who are the promoters, what are the kind of uh, people who have promoted it, what is their inclination towards the business. All these kind of things are very important when you go and invest in a particular bond issued by a particular entity. Don't just look at the yields and the returns, because that might give you a misleading picture. So that is the main thing that you have to look out for.
Arnav, I think that will be all. Thank you so much for taking time out and explaining our viewers all the aspects of high yield bonds. On that note, we'll take a quick break, but then post that, let's get into a discussion with PPFS CIO and Director Rajiv Thakkar on the markets and investment strategies for you after this break.